It is a pleasure to be back here with you just a week after our last webinar to do with the coronavirus crisis and the CARES Act, the unprecedented fiscal and monetary stimulus that the US federal government has thrown at the United States to help bolster the economy here. Good evening, my name is Ashley Murphy, Certified Financial Planner, Accredited Investment Fiduciary. I am the founder and principal of Arete Wealth Strategists. We are the only registered investment advisor in the US focused on helping Aussie expats here, Aussie expats soon to depart, and Americans in Australia. Tonight's presentation is to do with the impact of coronavirus on this very particular segment of the population. All right, let's get into this. So of course, no presentation is complete without disclosures. This does not constitute personal advice. This is general information. I see a number of clients of mine have joined, so they're in good hands, but anyone else would be well advised to speak with a CPA or a financial advisor, tax attorney, or a specialist in this area that knows what they're doing to obtain personal advice. A little bit about me. So I'm a tri-citizen, born in England, raised in Australia. I've lived in the US for 15 years. Went to the University of Queensland, moved to the US in 2005, worked as a corporate financial analyst, saw the light in, it was very bad timing to see the light, but saw it in 2008, made a career transition to become a financial advisor, which is really what I was destined to do. I love what I do, love helping clients, I love being involved in the markets, finding strategies that apply to individuals. So I really appreciate the work that I do and the clients that I do that work with. Here's a little bit more about me. So I've been a lecturer at UC Berkeley Extension and Golden Gate, been quoted in a bunch of places, and I'm a fairly regular conference speaker in the US and to a lesser extent in Australia as well. A little bit about my firm. So we're fee only, which means we're only ever paid by clients directly. We're cloud-based. So whether you're in Melbourne, Florida or Melbourne, Australia, you're able to access your files and view your portfolio performance and just see everything that constitutes the relationship that you would have with my firm. Virtual and in person, of course, much more virtual during the lockdown than in person. Presence in Minneapolis, where I look upon the frozen tundra right now. Hopefully that tundra, or the frozen part of it, is soon to melt. So the business really consists of two sides. There's the domestically focused side on business owners and executives. And then, of course, as you heard me say earlier, Aussie expats and Americans in Australia. So I'm really in my sweet spot right there in the middle with Aussie expat business owners. All right, so clients who we work with, here are some examples of the kinds of issues that we work on. But without further ado, let me get into tonight's presentation. So we're going to be looking at a couple of things. Of course, the economic ramifications of the coronavirus crisis, what's going on with the Australian dollar, the CARES Act, a brief summary of that. I would refer you to last week's presentation, which will be made available at the same time that this goes on YouTube. We didn't want to send out any more emails than we absolutely needed to. And that, I promise, is true. I really do try and throttle that back. How might this affect your super? What about expat property owners? And what might this do to property prices in Australia? Oh, I should say, there's actually two more things. Is it a good time to invest to take advantage of the strong dollar and low stock market? And lastly, would be general financial planning principles that apply to US residents, which of course, if you're living in the US, then you are a US tax resident, and thus it would be relevant to you. All right, so let's get into tonight's presentation. We really have an economy with a split personality right now. We have Wall Street on the one side that is going gangbusters, and I was shocked as much as anyone when I looked at the year-to-date performance of the S&P 500 today. Look at it, year-to-date performance. If you ask the average person on the street, they would say, oh, we're down, it's terrible, this is a Great Depression, oh dear. And they would say, we're down 30 or 40%. No, we're actually not, we're down 14%. 14%? That puts us right back less than a year ago. Less than a year ago. That's only one measure, of course, that's the S&P 500. But you compare that with Main Street, and results and statistics you'll see later in the presentation to do with unemployment. The speed of this decline, the amount of jobs that have been lost is simply unprecedented. So it's difficult to reconcile where we go from here, given the magnitude of the situation we see on Main Street, and yet the support that we're seeing from the US federal government and other governments around the world, and what that's doing to prop up the economy. So there you have some of my talking points. As recently as 6 weeks ago, a financial advisor friend of mine said it very well. He said, gosh, March was such a long year. And it was. To think back that on the 20th of February, we hit the high, the all-time high, hit for 20th of February. And we were down at about 3.5% unemployment, the lowest in 50 years, going back to the 1960s. Now, according to the bipartisan nonpartisan economic policy institute, we're talking about 16% or so unemployment, the highest since the Great Depression. And of course, not surprisingly, the states where you would expect to see this unemployment in particular are going to be those especially exposed to leisure and hospitality. So think Florida, think California, think New York City, and of course, parts of Texas with oil and gas. Here was an interesting infographic I located. Source is Lord Abbott, which is the name of a mutual fund family in the US. This is an infographic comparing the nature of the job losses. And you see in the global financial crisis, down in the bottom half of the infographic, we saw 7.1 million total job losses. In March, we saw 7.13 million cumulative job losses over the course of that month, of which only 54 were from manufacturing, 54, which is 540,000, because this is measured in thousands. Only 540,000 were from manufacturing, compared to the last go around where we're looking at 3.12 million. So the upshot of, and then you see, sorry, in leisure and hospitality, almost a huge amount, 459, well more than half of the total job losses are coming from leisure and hospitality. So really quite focused. And that's been my experience as I speak to clients, is I have got some freelance clients, not really in leisure and hospitality so much, but in businesses that are in person, that are client facing, and they're despondent, and understandably. And then on the other hand, I talked to my other client who's in IT cloud security, and you can imagine it truly is a tale of two cities. So continuing on here, we've got an unprecedented recovery package. Again, I went through that in great detail last weekend, on last Tuesday evening's webinar, which will be up shortly. They're injecting capital, going nuts with that. Paycheck protection program, that's just been extended. There's another, it was $349 billion. They've added another $250 because it was oversubscribed. The government is really throwing everything they've got at this stimulus. And not that it's tonight's presentation, but I can't help but wonder what the future implications of this might be for the indebtedness of the US and how we're going to get out from under all this debt. So stock market rebound has been substantial. And I actually want to show you this just very briefly. Let's come over here to the chart I wanted to show you. And it's this one from Yahoo Finance. We see this is from March 23rd, from the bottom, from where we hit the trough there, down 33% year to date at that point. And then look where we've come just in the past few weeks. So we're up 23%. And it's funny, when the cries, when the panic is at its peak, that's when people are tempted to go to cash. And that has not served clients well necessarily that have done that. Nevertheless, let me continue back here. All right, this was the nature of the CARES Act and all the different components that it consisted of. 2.3 trillion in total. Okay, the Australian economy. Here's what we have there. Exports are doing well, rising house prices, stock market hitting record highs, labour market slowly improving. There was reason for cautious optimism into the longest bull market in history. But of course, the coronavirus has hit, things have changed. If you look at the impact of coronavirus on Australia, however, it truly is significantly less in terms of infection rates and deaths on a per capita basis compared with the US. So while the lockdown has been more restrictive, I think that it's likely that the recovery will be faster, given that the stats just don't support a paranoid fear of holding out, given the propensity to test and the proactive nature of the lockdown. So what might happen? Budget surpluses will disappear. Well, they're gone anyway with bushfires, but now the supply side, the taxation is going to be reduced given the unemployment situation as well. So cash needs to be injected to get things going, and here's the source from which this comes from. PIMCO is saying we expect the global economy to transition from intense near-term pain during the virus suppression phase to gradual healing over the next 6 to 12 months. Once the spread of the novel coronavirus is under control and the restrictions are, well, that's exactly what I just said. Okay, international economy. This will give you some idea as to why the S&P is up 23% in the past 3 weeks. Compare the size. Japan is rarely to be outdone with the scope of their stimulus packages. But you see here, the US is coming in around 9.5. We've got another statistic coming up that says a little over 10%, but 10% of GDP, a phenomenal number, just absolutely incredible. They do not want to see the economy tank, especially in an election year. This is a very, very profound graphic. So this is from the Financial Times, who in turn sourced it from the IMF. So different scenarios about the baseline recoveries for advanced economies. And here's what we see. 3 scenarios. The dark blue line at the top is talking about a longer outbreak and what that might do. We're talking, this is negative GDP from the baseline, which is already negative to begin with. So we're talking about something that drags on for a couple of years. A new outbreak next year is going to pull things even lower. And then the worst combination would be a longer outbreak in 2020 plus a new outbreak. However, what needs to be said here is the timeline. Of course, impossible to speculate with any confidence whatsoever, but the timeline to a vaccine being produced is said to be 12 to 18 months. GlaxoSmithKline and Sanofi Aventis are working together on a joint venture, which for them is unprecedented, to try and get a vaccine to market as quick as possible. Thank goodness. So next topic, what's going on with the Australian dollar and what can account for what we've experienced thus far? So we see that up until about the 10th of March, I think it perfectly tracked my trip to Australia. As soon as I got back and things didn't need to be less expensive, the dollar plummeted. So from about the 10th of March, for the next, I believe it was 12 days, the dollar went from about 66 down to 57. Since that time, we've seen an installation of a swap line between Australia and the US, and also the support that's come from the respective governments to prevent a meltdown has caused the global flight of capital to safety, to the reserve currency of the world, the US dollar, to slow. And so we're edging back to where we were. I don't expect that that's going to last, however. And here's why. So we see what occurred. This is the graphic evidence from the JP Morgan Guide to the Markets that shows what happened. You can see an almost vertical increase in the value of the US dollar versus a basket of currency. The US dollar index is against 20 other leading currencies. And just a complete panic, as this exponential infection took hold. And that bounce back has been led by the central banks and treasury departments, as you saw in the earlier slides with those significant interventions. To do with the forecast, what can we see here? So with Australia, comparing the pairwise interest rates, one of the data points that I use in order to make a medium-term forecast about the direction of the currency is to do with the relative interest rates. And until about 6-7 weeks ago, it was the case that the US had a higher rate than Australia did, which of course would naturally support a higher dollar in the US than Australia. Now they're both down at zero. So that takes away that particular data point. There's no relative benefit to keeping your cash in a savings account in Australia versus the US. So we really need to keep our eyes on a couple other stats, namely the economic strength of three countries, the US, China, and Australia. And I think all the listeners here tonight will know why I say those three countries. And the reason for those three countries, of course, is the US and the strength that it's able to, the economic strength it's able to achieve to draw in US dollars so that people can buy its country's exports. China, of course, being the number one export partner with Australia. And then, of course, Australia and all its other relationships and export partners around the world. It's my prediction, as I look at the tea leaves, my crystal ball's a little bit cloudy, but I would expect to continue to see a decline. Why? Looking beyond the coronavirus crisis, what's out there? I'm seeing the trade war continuing. That hasn't stopped. That's just been overshadowed. The trade war continuing, and I think Australia's going to be caught in the middle. Australia's going to be caught in the middle. So if China doesn't have a strong recovery, then Australia won't be in the position to export the resource materials that comprise the majority of the exports to China in the first place. So on the flip side, this could be good news, continuing good news for Americans, Australians based in America, or Americans in Australia with US dollar assets. And we'll talk at the end of the presentation about some personal financial planning moves you might consider. So quickly, this is just a very quick recap from last week to do with the coronavirus crisis and the recovery rebates. So essentially, we're talking about $1,200 each, 24 for married couple, 500 for each kid under 17. Therefore, for a nuclear family, you'd be looking at a $3,400 payment. They're said to be coming through any day now. I've got a link to this stimulus calculator on my website that you can go to figure out how much you would receive, as there are phase outs at certain levels of adjusted gross income. Here's an infographic from Michael Kitsis, to illustrate how they come into effect. So it's $75,000 for a single filer, up to $150,000 for a married filing joint, and disappearing entirely at around $200,000 for married filing joint with no kids. Okay, other provisions here, you can take a $100,000 distribution. Let's be clear in our language. Distribution is not a loan. This is money you're taking out of your IRA or 401k. It's coming out. Now, that's not to say it's tax-free. It's simply free of the 10% penalty tax. It's going to come out for a legitimate reason, but the reasons are broad. Either you've got coronavirus, or you've been laid off, or work's been reduced because of that. And there's plenty of people in that situation. So benefits of this, as you heard me say a moment ago, the penalty tax is removed. It's eligible to be repaid over a 3-year period, but it is still taxable, remember, as you heard me say. Next, there's been changes to the loan provisions of employer retirement plans, read 401ks, 403bs. It used to be that you could only take up to $50,000 as a loan. Remember, all that glitters isn't gold. What the government giveth, the government taketh away. With a 401k, a loan, while you're borrowing money that was in fact contributed with pre-tax dollars, you're paying it back with post-tax dollars. So it's not a Harry Houdini tax trick if anyone thinks that they're doing that. Again, I would not encourage any clients to do that. there's one guy, a real estate investor who's a very, very, very specific niche. Is the only one that I would mention a very particular strategy to about that, but that's one individual. Payments are delayed a year, but essentially it's just a loan. That's all we're talking about. It's just a loan. Other tax provisions, employee payroll tax credit, employee deferment, the employer, not to be confused with the employee, employer deferment at the 6.2% side of Social Security. There's been a great enhancement to net operating loss carry forwards and carry backs. And let me see, a bunch of other loans, which we won't be going into tonight, paycheck protection, and what's the other one, the EID. Gosh, the acronym escapes me right now, but basically it's just a normal loan. However, if you are declined, then they'll grant you $10,000 anyway. They don't use the word grant, they call it a forgivable loan, but that's essentially what it is. Okay, how might this affect your super? Well, a provision was announced from Parliament about a $10,000 early access in 2019 and another 10 in 2020-21. However, it is very restrictive, as you'll see on the next slide. So it's the ATO that's going to be enforcing who is eligible for this and who is not. I'm just going to cut to the chase here. Is all these words and conditions and limits, and answer the question for you. If you're overseas, you cannot be a job seeker payment. You cannot be unemployed for the purposes of obtaining a superannuation advance because you're not a resident in Australia. Simple. So it really doesn't apply. It really doesn't apply. If you're moving back to Australia, different story. But for anyone overseas, it's just doesn't make sense. How might this also affect your superannuation? I think not unlike the slow-moving drama we saw unfold with the Royal Commission in the financial services sector in Australia, I think there could be some more that we'll hear about superannuation. I think they've got tremendous lobbying power, and the disgraceful lack of transparency that exists by law. This is by law, and you can read more about this in a white paper that we've got coming out in the next few weeks. The disgraceful lack of transparency that exists in industry super funds, I think, could be due for a shake-up as a result of what's happened. We saw unprecedented volatility. The VIX momentarily hit 67 back there on March 13th. And what were supposedly advertised as being balanced portfolios turned out to, in fact, be 80% growth assets. So there's been a loss of faith in certain super funds. That was Q Super that was responsible for that particular incident right there. I'm going to make this presentation available in view-only mode on my website, so you'll be able to click on these links here. This is a link to a presentation we did back in January, comparing how Morningstar, they do their biennial investor presentation, global investment experience study, and we've broken that down and made it relevant to Aussie expats to compare and contrast the pros and cons of the different markets. But transparency was noted to be amongst the worst in the world in Australia, as is legally required to be disclosed. Many funds report on a much better and more transparent basis, but they're not legally required to. And here's another example here from Q Super. So they've instituted, for the sake of income protection insurance, a pandemic exclusion. So now there's a 30-day wait. So if you're feeling hot and feverish and think you might run out and get that coverage, then it won't make any difference anyway. All right, main residence exemption. What does a property owner do? Well, it's not good. It's not pretty, because the main residence exemption still stands, or lack of main residence exemption still stands. It's going to go into effect on the 30th of June. You have until then for the contract to be in place. Settlement need not occur until the new financial year, but hopefully, still fingers crossed that something happens there. Clients that I've had in this situation, I have encouraged them. Not surprisingly, if anyone's been following my material on this for some time, they'll know that being an expat property investor really makes just about no sense. And that's why we've produced this guide to that very topic, and go through there and essentially make the case here that they've removed capital gains exemptions. You're getting taxed at 32.5% from the first dollar, removal of basically every sweetener that would make sense for a domestic client to be invested in real estate. Doesn't exist for a non-resident property owner. And it gets worse. Of course, there's been a lot of economic difficulty and significantly so for tenants and landlords, of course, who have faced unemployment as a result of this crisis. So landlords and tenants are going to need to produce documentary evidence in order to see relief. In South Australia, they've endorsed a number of initiatives aimed at helping both landlords and tenants who've been affected by this to try and support them. So the new measure is aimed to institute a short-term moratorium on evictions. Now, not for 1 minute am I saying that the policy should be any different. But on the other hand, the other side of the coin is that for the property owner, for the investor, things might get tight. The cash flow from the property could look difficult over the coming months if you have tenants in these situations. And I was actually just talking to my dad about 10 days ago, and he has a tenant in one of his investment properties who owns a gym. Not many people in the gym. In fact, there's none whatsoever. And so he's asked for a rent holiday, and that's just the kind of situation that is going on all over the country and all over the world. So what's this going to do to property prices? What do we expect? Well, it's supply and demand, right? People can't borrow money, they can't buy property. And so if the demand side goes away, or not goes away, but is diminished, then as Shane Oliver here, the storied economist, who's now a chief economist over at AMP, that's what he's suggesting. It's a 10 to 20% decline. So things could be pretty tight. All right, next, what do we have here? So this, somehow, let me see. No, I just tested this slide just before the presentation. I apologize here. So this is what I was going to say is, if you currently hold, is it a good time to get into the market? That's the question here. Is it a good time to get in the market? Well, it depends what you're talking about. If you're in Australian dollars, I can't say. If you have US dollars and US assets, it may well be a good time to get in. Why? US market has made a phenomenal comeback, as you saw with that chart. In fact, let's go back to that chart momentarily, just to take a read on that. You'll see some other points that I was hoping to make here. So here we are. From March 23rd, April 14th, we're up that 22%, 23%, excuse me. What if we do year to date? This is the point that I was making earlier. Look at that, 12%. You can see it's over here in the left-hand corner in that little box, open, high, low, close, volume change. We're talking 12% down year to date. So that's what I mean is multiple personalities for the economy right now. Let me go back to the presentation. Okie doke. So there's a strong recovery scenarios forecast. If you saw the numbers there in the previous slide, we're talking about significant growth once people get back to work. It might be slow. I'm not saying it's going to be rapid and sudden, but consider that 6-7 weeks ago we were at record highs. So there could be, that's not to say it's not without downside risks. There's always risks in investing, of course. But there are some strong, there's a strong bull case to be made here as well. Might also be a good time to repatriate. So for your own personal financial planning reasons, if you need to be moving money from the US to Australia to fulfill near-term financial goals, it might be a good time for that. Okay, I'm going to reload the presentation again and continue where we were. I'm sorry. Okay. So what's this chart right here? This is from JP Morgan's Guide to the Markets. It's an institutional slide deck only. This has got a lot of really useful information on it, and I hope you can stay engaged. A lot of numbers, but please stick with me. What we see here is the 25-year average, PE. We're seeing 16.33 price earnings ratio. That's where we are now, or excuse me, that's where we were at the end of March, is down there at 15.43. So strong opportunity. I should rephrase that. An opportunity. I don't know if I'd use the word strong, but an opportunity there on a PE basis. On a cyclically adjusted PE basis, Robert Shiller here, this is his invention here, the 10-year average, going back, prior 10-year average, we see the latest is 23 versus 27. That would suggest value. Dividend yield, look at that, is spruced up by 34 basis points. Price to book, lower than the 25-year average. Price to cash flow is slightly worse. I'm not surprised by that, given the evaporation of revenue in many businesses. So that can make some sense to me. And then the credit spreads, yeah, that's another matter right there. But from a valuation perspective, things look positive. That's what I make of this particular slide. Okay, we're going to move on to personal financial planning considerations that are specific. This is to the American residents, Aussie expats living in America. Review your overall financial position and just see how your picture for financial independence, retirement, or any other major goals might have changed. More likely to be due to unemployment than asset declines, unless you went to cash. Okay, so review your monthly spending, of course, make adjustments as needed. Tightening the belt by a little bit is much easier to do than very short-term steep cuts. Okay, Roth conversions. This can make a lot of sense. If you can transfer over assets at a reduced price and get them into a bucket that won't be taxed in the future, provided, note my words here please, provided you are a US tax resident. If you are moving back to Australia, I would not suggest this because Roths don't make sense in that context. They can end up being double taxed. But for those that intend on staying in the US, this would be an attractive opportunity to fund an account that will be free from future taxation, provided no change in the law. In earlier this year, I don't know why, it could just be the risk management professor part of me, but I got into that reality TV show, Doomsday Preppers, and this is kind of what makes me think of that when I read about this slide, is prepare a game plan for what happens if your emergency reserve runs dry. Remember, you can pull money from retirement accounts with penalty, of course, home equity lines of credit. There's a range of different places to go if things get really bad, but that's not what we're predicting. We're thinking the end is in sight, where the daily number of new infections in the US, at least, is beginning to slow down. It has not flatlined. It's merely the pace of growth has slowed. So maybe we'll be seeing the light at the end of the tunnel. Consider reducing or eliminating payments that don't have to be made. I would support this. You know what? I would support it because I'm fairly fiscally conservative. And I think if you put that aside, I coach clients in a budgeting methodology that's proprietary to my firm called the cash flow waterfall. We say suspend it, put that money into a surplus savings account until this blows over, until it's clear the recovery is underway, and then go back and continue making those additional principal payments on your mortgage and put that money into your kid's 529 account or whatever the case may be. Don't forget, there is a once in a lifetime, and I mean that literally, not just hyperbole, there's a once in a lifetime opportunity to do what's called a qualified HSA funding distribution, where you take money from your IRAs, limited to the annual max. So that's, I believe, what is it, $3,300 this year? Excuse me, $3,550 for an individual and $7,100 for a family, that you could move from your IRA over to your HSA if you have healthcare expenses. So that's a little known planning opportunity that's available there. For business owners, remember that there are a number of things that you can actually clamp down on. For instance, cash flow is very tight right now. Remember that, excuse me, depending on the plan language, you may have an ability to suspend contributions for a period of time. So that could be a way to save a bit of cash. And of course, always good advice. People are beginning to think about their own mortality. It's an opportune time to consider your healthcare proxies, living wills, and advance directives so that should the unthinkable happen to you, your loved ones won't be locked out. They won't be rudderless and have no idea what your actual intentions are, and be able to act or even hear what your medical situation is like. Next month's webinar, I want to crowdsource this. This is what I did. I said this slide was originally entitled next week's webinar, but I think I'm going to take a break for a month unless someone comes up with something really compelling. So perhaps there's a topic you would like for us to explore in a bit more detail. I just want to pause for a moment, see if we have anyone with any suggestions on that front. And it looks like with Google Slides, I need to close the presentation or to see that window. So anyone want to see any particular presentation next month or next week? I'm going to be going back to estate planning otherwise, which might also be of interest, but no, okay, no takers. All right, continuing on. I just wanted to mention some resources. I've put up a whole bunch of CARES Act resources, the calculator to the rebate, the recovery rebate, and a whole bunch of information about the Paycheck Protection Program. Fantastic program. Get on it if you're a business owner, a sole proprietor, or independent contractor. Feel free to come to the website. Also under resource, our key financial data sheet, white papers on passive foreign investment corporations and how that affects Aussie expats. If you are interested in speaking, then please come to the website, arete-wa.com. Click on Get Started and book a time. So fantastic. I want to open the floor to any questions that are out there. Anything I can help with, possibly. All right, do we have any questions? I know that people can hear me because we're from Kellen, Becky, and Chris that the sound is working, so that was encouraging. What about any questions regarding what we spoke about or I spoke about here tonight? Okay, Chris, not a question, but a huge thank you. And thank you very much. I appreciate your interest. Super informative and helpful. That's very kind of you. Thank you. All right. Well, don't keep it a secret. Please let other Aussie expats or Americans in Australia know. Please let them know about me and this resource. All right. Appreciate it, Chris. John Goldsworthy has a question. How do you see the US going? It has been declining over the past week. Actually, it hasn't been declining. I hate to contradict you there, but if we come here, I'll share my screen again in just a minute once I pull up the appropriate screen, and you'll see what I'm referring to. Okay, so right there. That is not a decline, that is an increase. I guess if you're talking about Aussie dollars to US, then it's been declining, but that's not the read. That's not what, wanting to send US money to Australia. Perfect. In that case, yeah, it has been declining when thinking of it in that regard. The strengthening the US dollar means you're getting fewer Australian dollars if you're converted. If you could have done it, made that conversion at any point, you would have done it in late March, of course. What's the direction there? I actually was speaking about that earlier in the presentation. I think once the dust settles from this coronavirus crisis, we're going to begin to see the dollar weaken again. And by that, I mean the US dollar decrease, like move back. I won't set a price target, but I think what we've seen is a rebound to get back to, now that the pipes have become unclogged, which is what I think accounted for that massive and abrupt decline, the fastest since the Great Recession. Once the plumbing has been cleaned up, I think we're going to see a gradual decrease because of the relative strengths of these different economies. If we just zoom out here, you'll see that same trend line has been in effect for some time. So that would be my answer to you, John, about that question. Any other? Oh, James Kelly. Hi, James. Thanks for tonight. We'd be interested in a future session on settling a estate from the US for a parent who passed. Sorry to hear about the parent who passed in Australia. That's every death is a tragedy. Yeah. Okay. Well, good. I'm also interested in putting that presentation together and getting that material out there. So we've got one vote for estate planning. Let me see. Under Q&A. Okay. I just got out of the chat. Now I'm looking at the Q&A. Okay. Anonymous. Anonymous wrote, someone who is setting up a company and not, what's this? Someone who was setting up a company and not live for revenue, any options for relief on an E3D. You know, actually, I'm glad you brought that up. I can't totally discern the question, to be honest. But what I will say is that in the haste with which the Paycheck Protection Program was rolled out, they did originally say you must be a US legal resident, not citizen, just you could be a green card holder or even a visa holder, but you had to be here legally to apply for that. That's changed. The language is now something to the effect of has significant economic impact in the US. And I think that's a much more liberal interpretation. So I would think you could apply for a Paycheck Protection Program loan. What's that worth? 2.5 times monthly payroll of your average 2019 payroll. There is some ambiguity as to exactly what payroll includes, but it's definitely your W-2 employees with a cap at $100,000 annualized. Please check out last week's presentation on that. Ellie writes, what did you say the tax rate on Aussie property for non-resident is? I said it's 32.5% from the first dollar, assuming it is cash flow positive in the first place. Anonymous writes, what's the best method platform to transfer? Oh, I love this question. I love it. What's the best method or platform to transfer US dollars to Australian dollars from an anonymous attendee? Well, okay, the best that I've come across, and I do this for a living and have done for the past decade, is Interactive Brokers, where they have a 0.0002% spread. And the spread is the amount that the converting bank takes from the interbank rate. So it's effectively the fee you're paying. I've got actually did a whole presentation on that. I believe it was September of last year, where we go into detail. The thing with Interactive Brokers, as much as I love them, they are extremely difficult to use, and the customer service, to be honest, you get what you pay for. So that's the downside there. And then for my clients, I've negotiated a rate with a provider, AFEX, AFEX, that's half the best retail rate out there. So doesn't really answer your question, but it does in a way. If you're willing to suffer through and learn about Interactive Brokers, then that would be the way to do that. Neil, hi Neil. Does the IRS base ownership of family trusts on directorship or on shareholdings? Wow. I have to presume, Neil, you're talking about an Australian family trust there, as opposed to some sort of US revocable living trust. And I'm going to presume because no one, for whatever reason, refers to a trust as a family trust in the US, they refer to them as revocable living trusts. Effectively the same thing. I couldn't answer that as to the base ownership, but what I can tell you, which I still think would be useful, is that for the purposes of source of income, that's deemed to be an Australian source. So if you own significant assets, even if you're invested in the US for that matter, it doesn't matter. You're not going to get US, you're getting the worst of both worlds. It's a little bit like investment property in Australia as a non-resident. You're getting taxed at the Australian rates on that because it's deemed to be Australian sourced income. Mr. Robert Bressy, how are you, my friend? Is the market increase during such a dark time highlighting the difference between retail and institutional investment strategies? Or is there some sort of coherent explanation behind why the market might be going up in the face of such horrible forecasts for world economies? I would say the succinct answer is it's going up because there is the Federal Reserve and the Congress, so we're talking monetary and fiscal stimulus, has been unprecedented. It's just, this is World War II, and suddenly the world has learned of a new weapon. The trillions of dollars, more stimulus than the Great Recession. So big business isn't particularly worried. But what I can't make sense of in this multiple personality economy is how the restaurants, how the local theaters, how the local gyms, how they all get back on their feet without getting deeply indebted. And the other interesting sort of side point there, which doesn't quite answer your question, but is how do restaurants get going if in the first phases of the restrictions being lifted, if they can only seat someone at every second table? They're on razor-thin margins as it is, and so that's not really going to be viable. I think there's going to be much more support coming down the line, and I think that's what has emboldened institutional investors. I'm going to read your question again, just so that I'm clear that I answered that. Is the market increase during highlighting the difference between retail and institutional investment strategies? I don't think it is. I don't think it is highlighting a difference between the two. It's not as if, and by institutional, I don't think you mean working with a financial advisor. You mean like, say, private equity or hedge funds or something like that. No, I think I think I gave a good answer to that. I think it's accounted for by the scale of the stimulus. And Neil, yep, Australian Family Trust, and that's what I thought you meant. And that's how I answered that question. We haven't had any more questions. I want to thank you very much for attending here tonight. We will send an email in the next 48 hours with tonight's recording. I'll put the presentation up on my website, and you all have a wonderful evening. Thanks so much. Bye.